Welcome to The Explainer. Today, we're diving straight into one of the absolute wildest financial puzzles in the market right now, the incredible paradox surrounding SK Hynix. We're talking astronomical profits, violent market crashes, and a staggering $29 billion maneuver by management. If you really want to understand how the market is processing information in the AI era, instead of just buying into the hype, well, you're in exactly the right place. So let's just get right to the central mystery here. Is this a buyback or a bailout? Is management's historic multi-billion-dollar move a sign of unshakable strength? Or is it basically a desperate attempt to stop a bleeding stock? To figure out how foundational tech giants are being priced right now, we really have to look under the hood. Let's look at the immediate reaction. 6%. Literally hours after SK Hynix dropped this massive $29 billion share buyback announcement, the stock rocketed up 6% in the pre-market. I mean, it sounds like a total victory lap, right? A dominant tech company absolutely swimming in cash from the AI boom, aggressively returning capital to its shareholders. But then we hit the reality check. Because despite posting its best quarterly profit in history, this exact same stock has completely crashed. It's down more than 50% from its June highs. It's a staggering disconnect. How does a company achieve record-breaking historic profits in the hottest sector on the planet, only to see half of its market value just wiped out in a matter of months? To make sense of this, we've got to look at the mechanics of the buyback itself. The company is targeting up to 24 million shares, which is roughly 3.3% of their total float. But here's the really critical detail. Unlike a lot of tech companies that use buybacks just to cover employee stock options, which, let's be honest, just waters down your investment by issuing those shares right back out, SK Hynix is permanently retiring and canceling these shares. They're out of circulation forever. Think of it like a giant pizza. If you take away a few slices but keep the whole pie the exact same size, the remaining slices just mathematically get bigger. And that is exactly what's happening to the earnings per share for the remaining investors. And they aren't stopping there. Management has raised their shareholder return pledge to over 50% of cumulative free cash flow. This isn't just some one-off PR gimmick. We are talking about a massive financial commitment. They are tying more than half of the actual unencumbered cash the business generates directly into rewarding the people holding the stock long-term. So why are they pulling the trigger on this right now? The motive really comes down to one single crazy metric, 6.6. That's SK Hynix's forward price-to-earnings ratio. For a company sitting at the absolute center of the AI revolution, growing its revenues at triple digits, a forward PE of 6.6 is absurdly low. It signals extreme value. Management is basically looking at the sheer volume of cash they're printing, looking at the depressed stock price, and deciding that buying themselves is literally the best return on investment out there. And Wall Street analysts completely agree that the stock is sitting in a deep discount zone. The consensus price target is hovering around $245. That represents a massive 57% upside potential from where we are right now. The professionals who actually track these global supply chains and model future cash flows see an enormous runway ahead that the broader market is just ignoring. But again, if the fundamentals are so undeniably strong, why the 50% crash? Well, it boils down to this idea. The market is in show-me mode. You see, the recent crash wasn't because the underlying business was failing or losing market share or anything like that. It was because the market had built up impossibly high speculative expectations. Investors were demanding flawless perfection. So when SK Hynix delivered merely record-breaking profits, instead of shattering the wildest upside targets imaginable, the broader market essentially threw a fit and sold off. Section 1. Dueling perspectives, the bull versus the bear. To really understand the extreme volatility we're seeing, we have to objectively weigh both sides. On one hand, the bull case is entirely driven by the AI supercycle, this insatiable global demand for high bandwidth memory and a high beta. But then, on the other hand, the bear case is anchored in very real macroeconomic fears, stubbornly high interest rates, choking global liquidity, and the persistent worry that this buyback is just a temporary cushion that's going to deflate once the program ends. Digging into the bull case for a second, the underlying industry dynamics are just incredible. Memory is projected to make up 48% of the entire semiconductor market by 2026. And more importantly, SK Hynix's high bandwidth memory, or HBM, is effectively sold out all the way into 2027. This isn't just hype, it's locked in contractual demand. Nvidia simply cannot manufacture its industry-leading AI chips without SK Hynix memory acting as the critical backbone. And this brings us to why the stock moves so aggressively. It has a beta of 2.4. Let me translate that financial jargon real quick. It simply means this stock moves more than twice as violently as the broader market. If the overall market goes up, SK Hynix absolutely rockets up, which perfectly explains that explosive 6% jump on the buyback news. But naturally, if the macro picture gets nervous, a 2.4 beta means the stock is going to crash twice as hard on the way down. It amplifies every single emotional swing. Now, factoring in that massive volatility, there is a fascinating divergence happening right now among top Korean institutions. The smart money is placing very calculated bets. While SK Hynix is down 50% from its highs, local institutions are buying it up heavily. Meanwhile, its major rival Samsung is only down 20%, yet those exact same institutions are actively selling it. Why? It tells us that local smart money views the SK Hynix dip as heavily overdone compared to its peers. They are betting the core business is perfectly intact and just taking advantage of an extreme discount. Section 2, the investor playbook, navigating the volatility. Okay, so we have the paradox, we have the data. Let's shift into some actionable strategy. Here's a clear 3-step playbook. Step 1, watch the macro. Stop staring just at the daily stock chart and keep an eye on the 10-year Treasury yield. Capital-intensive tech stocks are highly sensitive to interest rates. Step 2, manage your entry. Because of that massive 2.4 beta we talked about, you have to manage risk aggressively. Dollar cost averaging is your friend here. And step 3, identify the catalyst. The buyback plays great defense, but a real sustained breakout requires a major macro shift, like the Fed firmly blinking on rates or HBM demand somehow exceeding the already sky-high forecasts. Section 3, the verdict, fundamental strength versus market irrationality. Bringing this all together, timing is absolutely everything. After crashing from this June highs, this massive share buyback kicked off on August 20th and runs right through November 19th. What management has effectively done here is build a firm, 90-day floor under the stock. During this window, the company's aggressive purchasing acts as a huge buffer against broader market sell-offs. Basically, patient investors are getting paid to wait out the storm while the company buys up the float. Which leaves us with this final, incredibly provocative question. Based on the deep, fundamental value, the undeniable multi-year AI supercycle, and the massive $29 billion backstop provided by management, is SK Hynix currently a generational buying opportunity? Or, given the global macro risks and extreme volatility, are investors just trying to catch a falling knife? Weigh the evidence we've walked through in this explainer, consider your own risk tolerance, and decide for yourself. Keep learning, stay curious, and we'll see you next time.